Hi, guys. This is Direk Khanijou, and welcome to my podcast. Let's say you just moved to Japan and you want to be successful in Japan. What is the first thing you should do? That's easy. The first thing you should do is go out and learn Japanese. Because without an understanding of Japanese, it will be very hard for you to make a living in Japan. And likewise, if you want to be a good investor, you need a working understanding of accounting. This is because accounting is the language of business. The good news is that you don't need an accounting degree to understand accounting. Just like most things, you can learn accounting by reading a lot and by being very interested in the topic. The profession of accounting began a very long time ago in Renaissance Italy. It was Luca Pacioli who came up with the invention of double entry bookkeeping. But accounting didn't really become important until about the 19th century when stock market investing became more common. Now let's talk about the different financial statements. The three financial statements are 1. The income statement, 2. The balance sheet, and 3. The statement of cash flows. When presenting results, a company can choose to present any financial statement first. For example, Amazon chooses to list its cash flow statement first, whereas Apple chooses to list its income statement first. It is just a matter of preference. Let's start with the income statement. The income statement is also called the profit and loss statement or the P&L. It shows the company's sales and expenses over a period of time. A company will usually prepare an income statement to show its results over a quarter or annual time frame. But in reality, you can also prepare an income statement for any period of time. Excluding banks and insurers, the general format of the income statement is the same. It follows a step-down function, with the first line being revenue or sales, and the last line being net income or net profit. The income statement is read in a step-down manner, like walking down the stairs. Each item is a deduction of one or more expenses. A typical income statement will look something like this. Revenue minus cost of goods sold gets you to gross profit. Gross profit minus SG&A and R&D gets you to operating income. Operating income minus interest expense gets you to pre-tax income. Pre-tax income minus provision for taxes gets you to net income. One of my favorite numbers to look at is the gross margin, which is the difference between revenue and cost of goods sold expressed as a percentage. A company with a gross margin of 60% means that they make things for 4 and sell them for 10. Next, let's talk about the balance sheet. The balance sheet is a snapshot of what a business owns and owes at a particular point in time. The balance sheet must always balance. This means assets minus liabilities must equal equity. The balance sheet has 3 sections: assets, liabilities, and shareholders' equity. Assets and liabilities are further broken down into current and non-current. For example, items such as accounts receivables and inventory are considered current assets because they are expected to be converted into cash within 1 year or 1 operating cycle. An example of a non-current asset is property, plant, and equipment. And the same principle applies for liabilities. For example, current liabilities such as accounts payable and short-term debt are liabilities that will come due within 1 year. The 2 accounting standards you need to know are GAAP, which is used in the US, and IFRS, which is used outside the US. One of the differences is the order in which assets and liabilities are listed. For example, US GAAP accounting will list current assets first and then non-current assets. But IFRS will list non-current assets first and then current assets. And then within current assets, US GAAP will list the most liquid assets first, whereas IFRS will list the least liquid assets first. Next up is the cash flow statement. This statement captures elements of both the income statement and the balance sheet. The cash flow statement is divided into 3 sections: cash flow from operations, cash flow from investing, and cash flow from financing. Without getting into too much detail, here's what each section reveals. Cash flow from operations shows you the cash generated by a company's operating activities. Cash flow from investing shows you how much the company spent on capital expenditures, acquisitions, and any purchases or sales of marketable securities. Cash flow from financing shows you how the company is being financed. For example, did the company issue debt or equity? And how much did the company return in the form of dividends and share buybacks? There is so much more about financial statements that I haven't talked about. Let me know if you found today's episode useful and if you want to hear me talk more about financial statements. Please don't forget to like and subscribe. That is all for today. Thank you so much for listening.